Welcome to Finance Friday, our sometimes almost weekly podcast for discussion of money creation and its consequences. I'm Hard Money Jim, trying to stay warm here in Jackson Hole, where it's 20 degrees outside. That's about -7 Celsius, I think, for our European and English friends. And after getting down to nearly zero last night, that's about -18 Celsius. So we've had our first snowfall. It's cold, and I think it's going to get a lot colder. I know it will in the coming weeks. So winter is definitely upon us. And let me get my slides going here for you. And I expect to start seeing some migrating elk in my backyard here pretty soon. Now they're not here yet. But this is a photo that I took last spring after the snow started to melt. And it will give you an idea of what I see outside my office window at certain times of the year. So these elk, they're not here yet, but they're going to probably start showing up before Thanksgiving. You know, it's winter for sure. It's also winter in the stock market, as it has been declining since January. But the last 2 weeks, in the stock market, we've had kind of a false spring, meaning we've had a fairly substantial stock market rally. And I think the probable reason for it is interesting. And I'm going to use that as a backdrop to kick off our discussion today. The subject for today is the Fed's next move or their next moves. And the theme is that the Fed's next move will be the same as their last move. That is, they're going to either continue raising interest rates until they reach their objective of reducing CPI inflation to 2%, or, and this is more likely in my view, they'll raise interest rates until something goes very wrong in the financial markets, in which case they will again resort to some form of money printing to relieve the emergency, whatever that turns out to be. Now, this view I'm expressing is in contrast to a view that's apparently being signaled by the recent stock market rally. It's a view among investors that seems to think that the Fed has changed its mind and may stop raising interest rates after the December meeting, and that interest rates might not go as high as what many people previously thought. What the Fed ends up doing could be very important to us investors, because if the current market sentiment is right and the Fed takes the Fed funds rate to only say 4.5% or around that, and then stops raising rates, that could ignite a rally in longer term bonds, and it could be very positive for stock prices. However, I doubt that is the case. And let's explore why the market might think that and how I differ. Okay, so this is a chart of the Standard & Poor's 500. You can see from this chart that we're in a strong downtrend. Over here, this is January, and we're in this strong downtrend this way. This is a typical bear market pattern. It's a jagged sawtooth pattern with higher highs and lower lows as it grinds lower. And you can see on the far right, way out here, right here, that the uptick that we've had in the last couple of weeks, this is about 7%, probably more like 9%, because we're adding about 2% on in a rally today, last I looked. Now, the background for this bear market is, of course, the Fed's tightening policy, their inflation fighting policy. And up until this week, we had 12 consecutive weeks of rising interest rates and declines in bond prices. That kind of persistent move is rarely seen in history, and we really haven't seen it for many decades. So 2 weeks ago today, on Friday, October 14th, Janet Yellen started a small rally when she said the Treasury Department might be intervening in the Treasury market to repurchase the less liquid, the so-called off-the-run bonds, even as the Treasury Department continues to issue new current coupon bonds. The bond market got pretty excited about this and rallied, but I saw this as kind of a courtesy to bond traders, allegedly to help them with a smooth functioning of the market, but with no real long-term effect on interest rates. But anyway, Yellen floated this idea, and bonds rallied a little bit, even though they were down on the whole for that week anyway. But then, following that, this tweet took place. Remember this guy, Nick Timiraos, Chairman Nick Timiraos? He writes for the Wall Street Journal, and he came out with this tweet. And note the second paragraph. The Fed could be considering how to, quote, step down to 50 basis points at their December meeting. Now, it's a given in the markets that the Fed is going to raise the Fed funds rate from its current 3% to 3.75% at their November 2nd meeting. But what Nick is talking about here is that the Fed might be considering raising rates by only 50 basis points in the December meeting, at the December 2nd meeting. Prior to this tweet, the Fed funds rate future betting put the odds of a 75-point December rate hike above 90%. Almost immediately after this tweet, those odds fell to 50%. The bond market moved up somewhat, but the stock market moved up really sharply and then went on to rally this week. It looks like it's going to be about 7% rally this week, and that's a big move in 1 week. So remember, Chairman Nick is considered the mouthpiece of the Fed. So someone at the Fed regularly uses him as a mouthpiece to convey Fed intentions. And as far as I know, Chairman Nick has never been wrong. And in his column in the Journal, he wrote, some officials have been signaling their desire to both slow down the pace of increases soon and to stop raising rates early next year to see how their moves this year are slowing the economy. So by some Fed officials, Nick was referring to Charles Evans of the Chicago Fed and Lael Brainard, who is the Fed's vice chair. So very simply, Nick Timiraos is just saying that some Fed officials are concerned about being too aggressive with their rate hikes, even in the face of severe inflation reports. And their concern is that rate hikes take time to have an effect. And so this news apparently comes from some officials at the Fed, whoever Nick Timiraos usually talks to. And because it seems credible, immediately the stock market popped and interest rates on the two-year Treasury declined. Now, on the same day, October 21st, Mary Daly, the chair of the San Francisco Fed, she added fuel to the rally, and she also used the term, this new term that Nick used, step down. Daly said a slowdown to more incremental increases of 50 to 25 basis points would be appropriate as the Fed's benchmark rate gets closer to its terminal level for this hiking cycle. She did notice that it's not yet time to step down, but these comments from the Fed and from the Fed's mouthpiece left investors wondering, would a 50 basis point rate hike in December mean that the Fed thinks they're much closer to their ultimate peak in rates? So these two communications apparently coupled with a widespread belief among investors that inflation is really not a big systematic problem, but only a short-term problem that's soon going to be able to revert to the Fed's magic 2% number, that ignited a rally in the stock market. And the market seemed to see these comments as a potential all-clear signal from the Fed. The S&P 500 rallied, and as I say now, it's up a full almost 9% in the last 2 weeks. And bonds stopped their 12-week decline. You can see this chart here. Prior to this week that we're in now, we saw 12 consecutive weeks of bond market declines. We haven't seen that, according to Bianco Research, since 1984. So that's a very strong, persistent downward move in the bond market and an upward move in interest rates. Now, Recall that the reason for this relentless downward movement in the prices of both stocks and bonds is the Fed's tightening policies, which consist of higher interest rates and the policy of decreasing the assets on the Fed's balance sheet, also known as QT, quantitative tightening. So this 9% up move of the last 2 weeks apparently reflects a market belief that the Fed's is changing its tune, and it's time for a pivot. It's time to, quote, step down the pace of rate hikes and maybe not hike rates as much as the market previously thought. After all, Chairman Nick is the Fed's mouthpiece, and Mary Daly is a Fed governor, so this seems like good information. All right, now, I agree that the Fed will definitely step down their rates of increase someday. But my view is that they have made no decisions yet because CPI inflation, even though it may have peaked, is a long way from their 2% target, their self-imposed stable prices mandate. So maybe they will go up 50 basis points in December, or maybe they'll do 75 basis points, but that doesn't matter very much. What matters is how much they ultimately raise rates and how long they hold those rates high. And so, as I'm going to try to explain today, the thing that will ultimately someday cause the Fed to loosen policy or pivot or reset or step down or whatever you want to call it will probably not be anything the Fed can now foresee or plan. And when it happens, it will likely not be a very pretty or a very happy circumstance. In other words, if you are hoping for a change in Fed policy, be careful what you're asking for. All right, so what do I think the Fed's going to do? First, let's look at the Fed's guidepost, the measuring tool that they use to calibrate their next move. Their main tool is core CPI inflation, or their version of it, which is core CPE. Here I'm going to give you my usual disclaimer. I am using today the word inflation, CPI inflation, in relation to consumer prices, even though I think a proper definition of inflation is really an excessive increase in the money supply. But I'm using the Fed's terminology, their concept of inflation, because that's what we're looking at, okay? So anyway, here we have our usual CPI inflation graph here. The orange line is core CPI, or consumer price index, less food and energy. The latest number, September, is an all-time high for this cycle. The raw CPI number, the blue line, went down a little bit to 8.3%, but that's because gas prices declined a little bit. But core CPI has not yet peaked, and it shows no sign of declining. Gas prices are included in the raw CPI number, but gas prices are not what the Fed considers to be inflation. Maybe to you, but that's not what the Fed uses to make their decisions. Now, look at this, I hope not too complicated chart. It's worth looking at. This shows the Fed funds rate superimposed on the annual rate of change in the consumer price index. The blue line is the effective federal funds rate. That is the key short-term rate that the Fed sets directly and uses to benchmark its policy. The red line is the core consumer price index, the one I just showed you. Now look at the history from 1980 to about the year 2000 and see what the Fed had to do to get the core CPI number down to their magic number of 2%, which it did get down to, from like the 2010s on. Notice they had to keep the Fed funds rate much higher than the CPI. The blue line stays above the red line for a long period of time. So notice that not only did they keep the Fed funds rate well above the consumer price index, but they had to keep it there for an extended period, for years in some cases, many years. Notice also that the CPI fluctuated in its general downward trend, and the Fed had to repeatedly raise its Fed funds rate, as a CPI inflation sort of repeatedly missed its raised its head, like the two were fighting. In other words, it was a long battle with skirmishes along the way, and it was not clear at the time if the Fed would prevail over CPI inflation. Now look finally to the far right of the chart, way to the far right. And notice how much higher CPI is today than the Fed funds rate. CPI is the red line. Funds rate is the blue line. The Fed funds rate today is at 3.08%. Core CPI is 6.7%. The Fed is talking about a 75 basis point rate hike in November and another 75% rate hike, or maybe 50 basis points, 0.5% in December. That gets you to a Fed funds rate of something between 4.25% and 4.5%. That's obviously well short of the core CPI number of 6.7. And recall that we have to get the short-term interest rates above the core CPI to avoid this perverse incentive of consumers borrowing to spend on consumption. Does anybody think that core CPI is going to fall from 6.7 to 4.5 or lower by the end of the year? So it seems that many investors, by their behavior in the investment markets, are counting on the core CPI to decline fairly soon. But how fast can the CPI really decline? Remember that most of the prices in the core CPI are housing and services. How fast can they decline? It's true that the rate of increase in the cost of shelter, that's housing, is slowing somewhat. It is, and it will slow further. But recall that we've talked about this before, these costs take months to show up in the CPI, and the actual current CPI is what the Fed uses as a target. The other large component of the core CPI is, of course, services of various kinds. And a big component in all services is the cost of labor. Now, what you're seeing here is the average hourly earnings in the USA, courtesy of the Labor Department. Note that pre-pandemic, before 2020, the annual increase in the cost of labor was about 2 to 3% per year. But now it's risen, after some pandemic fluctuations that cancel each other out, it's risen solidly at or above the 5% range, 5%. So even when hourly earnings plummeted during the pandemic, during that spike downward there, they went down to a 1% rate of increase for only a month or two, and then popped right back up. They never went negative. So it seems we have 5% increases in labor costs built into the economy for a while. So I expect you will not get the service components of the CPI down to 2% unless you get labor cost increases down to that level, the same level they were when the CPI was at 2%. But but for that, you have to have a slowdown in the labor market. Now, is that in the cards? Because the labor market looks pretty strong. Unemployment's steady. It's at a very low 3.5%. Applications for unemployment relief are not going up. There's some indication that job openings are declining, but there's still a lot more job openings than there are people to fill the jobs. So far, there's no stress in the labor market. The labor market is telling us that the economy is not slowing down anytime soon. How much employment does the Fed have to kill in order to get wages to stop rising at 5%? Unemployment's the lowest it's been since 1969. If the Fed causes enough suffering to get it up to 5 or 6% unemployment, will that make the job market competitive enough to get wage growth to moderate? Remember, high unemployment does not necessarily mean lower inflation. During the 1970s, and at a time late 1970s, which I remember very well, we saw very high unemployment rates, and this was still insufficient to kill demand enough to get CPI inflation down. For example, in both 1979 and 1980, we had unemployment rates at 6 to 7% and CPI inflation at 12 to 13%. Now, that was true stagflation, a slow economy and high CPI inflation, a situation we could easily enter as the Fed continues hiking rates. In addition, real GDP growth came in recently, just a few days ago, above expectations at a positive 2.6% year on year. Does that sound like an economy in which the labor market is going to weaken anytime soon? Not to me. Then there's the problem that the recent stock market rally actually undermines the Fed's efforts to reduce demand in the economy. If the market stays high, the Fed believes that the quote wealth effect, that's the feeling of being wealthy because stock prices and house prices are high, the wealth effect goes up. So their theory goes, and people spend more. But the Fed wants the opposite. Remember that the wealth effect was specifically cited by Ben Bernanke when quantitative easing started back in 2010. He wanted to raise asset prices to cause people to feel richer so they would spend and invest more. The wealth effect is a stimulus in the Fed's view. But now they want to do the opposite. That is, generate a negative wealth effect to induce people to spend less, thus lowering prices. So when the stock market rallies like it has in the last week, that only increases the Fed's resolve to maintain tight monetary conditions. So how high will the Fed have to raise the Fed funds rate before the higher rates start to destroy demand? I would guess a lot higher than 4.5%. And an equally important question is, once they do reach their target rate, whatever it turns out to be, how long will they hold those rates high before they start loosening their monetary conditions? Now, no one, not even the Fed, knows the answer to that. If core CPI stays persistently high and comes down slowly as it did in the 1970s, it would be very easy to see the Fed getting funds up to at least 5 or 6% and keeping it there for a very long time. Now, that is actually my thinking, but it's not obviously not the thinking that's driven the market, players in the market to make stocks rally and bonds rally this last week. Now, on the contrary, there is evidence that many investors think the Fed is in control of inflation, that we're going right back to 2% CPI inflation, and that in a year or two, everything's going to be like it was in 2019 again, with low CPI inflation, low interest rates, and a booming stock market. Now, I've shown you these kinds of charts before, but it's worth revisiting. This is an excellent chart from Bianco Research, and it shows 20 years of inflation forecasts by Wall Street economists. Notice that since 2012, when that's the vertical line in the middle, when 2% CPI became the Fed's explicit target, that these Wall Street economists have been always forecasting a rapid reversion to around a 2% CPI inflation rate. No matter how wrong they are, and no matter how high the CPI goes, or even how low it goes for that matter, they persist in forecasting CPI inflation back to 2%. In effect, they're always saying today's rate is the highest it's ever going to be. And when it goes higher, they're saying today's rate is the highest it's ever going to be. Today, they're saying that even with CPI inflation at 8% plus and core inflation at 6.7%, that we're going right back to the 2 to 3% range by the end of 2024, only about 2 years from now. And amazingly, the majority of Fed economists think the same thing. This chart is the result of what's called the dot plot, where members of the Federal Reserve Board periodically forecast and publish their inflation expectations. Their individual forecasts vary a little bit. Let me check the time here. Yeah, we're good. The individual forecasts that they make vary a little bit, but in general, Fed officials are thinking CPI inflation is going to converge back to around 2% within a couple of years. Whether they all actually believe this or not is questionable in my view, but what is important is that they publish this and they act on it as if it were true. So I suspect that most economists still think CPI inflation is transitory. In my view, this is classic groupthink by our designated experts, something that we see a lot in many fields of expertise. But these, most economists think inflation is serious, but they think it's going to be fixed very soon. And recall that these are the same geniuses who did not see inflation coming in early 2021 until well after the fact. And they denied it was a problem until very recently. So why do they think CPI inflation is transitory? Why? My guess is they must think the recent surge in CPI is mostly due to supply disruptions from the pandemic, from the China lockdown, zero COVID policy, and of course from the Ukraine war and energy supply disruptions. Our president has blamed Vladimir Putin for inflation in a lot of cases. On top, and he gets that from his economists. Now, on top of that, there was a one-time demand shock, these economists say, and I have heard them say this, one-time demand shock from the sudden reopening of the economy post-pandemic. So I'm guessing they're thinking this combination of supply constraints and demand shock is what caused the price surge, and that it's therefore short-term, it's transitory. But what if the supply disruptions are more permanent than they think? And I'd like to ask you a few questions to ponder. Is China going to be the same trading partner it was during the period up to 2019, supplying us with tons of cheap stuff, cheap consumer goods? Or is China now in a more militaristic and a less commercial mood? What does the zero COVID lockdown policy in China say about their willingness to their ability to produce and their willingness to trade and supply us with all those cheap goods? And what will the sort of incipient reshoring of a lot of manufacturing to the USA, and with all that costs, all that entails, due to costs? And what about the world supply chain problems? Can those just reestablish can supply chain just reestablish itself like it was in 2019? Or there have been so many changes in the supply and demand patterns post-pandemic that we need major revisions to the supply chain, and that takes time. And what about the labor cost situation that I was talking about? Doesn't there appear to be a change in what people will do, how much they will work, at what price? What if there's a permanently higher labor cost built into the economy? Or, nothing's permanent, but let's say long term. And what about energy? Isn't energy showing signs of a multi-year cycle where costs are going to remain high? Green energy alone, if it persists, will keep energy costs very high. And as we know, higher energy costs affect most manufactured goods in a pretty profound way. So in all these areas, it sure seems like costs could remain persistently high for a long time. Now, another factor, perhaps even more important, that I think many investors are missing is the effects of monetary policy. And, it's my favorite chart here. As a result of years of QE, which was used to pump up asset prices and insert lots of new money into the banking system, there's just too much money chasing the goods. Short and intermediate term, the Fed can rein this in somewhat, but long term, our government's approaching a point where the required expenditures, basically the entitlements and the interest on the treasury debt, could overwhelm the government's ability to collect enough money to pay for it all. So that there's going to have to be some kind of reckoning in which the debt is paid down in cheaper dollars, and that means inflation for the long run. When that really kicks in, I don't know. But what I do believe is that right now, the spendable money in the system still far outweighs the supply of goods and services. And this is only due partly to product shortages that come from things like supply chain issues and energy shortages and disruptions in trade. So I think much of the pricing problem is due to just too much money. But the Fed has said repeatedly that they do not think the money supply has anything to do with prices. Simple logic tells me they are wrong about this. So if they are wrong about that, and then that means they completely missed the emergence of consumer price inflation. So how do we know they're not going to miscalculate the economy's reaction to their tight money policies? To the Fed, I think everything is going to be just fine until one day it isn't just fine anymore. Then something will break, and it'll be something that they cannot foresee from their ivory tower in the Eccles building. So for the present, the big issue for investors, as I see it, is the complacency of the stock market. And yes, the market is down, fully 20% from its peak in January. So it's kind of tempting to think it's corrected adequately from its very lofty highs. But the downward movement has been very orderly and surprisingly not very volatile. A real bear market, the kind that I've been through as a professional portfolio manager, managing the money of widows and orphans, that's a lot of pressure, by the way. A real bear market should show more panic, more volatility, more fear. But this market is orderly and calm. So meanwhile, as interest rates keep rising, the financial system seems more and more vulnerable to some kind of systemic event, some kind of shock, something like what happened to the UK pension funds in the Bank of England a few weeks ago, which we talked about, but bigger than that. And I think it's nearly impossible to know where the next shock's going to come from, because the financial system is just too big and complex and too opaque to predict with that kind of detail. But look at what always happens. This chart from Merrill Lynch shows how Fed tightening cycles with rising rates usually end, and it's usually not pretty. So Volcker hikes rates and then crashes the market in 1982. Greenspan hikes rates and crashes the market in 1987 and again in 94. Then there's a long-term capital management crisis, the tech bubble and the crash of 2002. And then, of course, the well-known subprime crisis of 2008. What generally happens is that the Fed hikes rates until something breaks, meaning some crisis interrupts their orderly, systematic plan. And then they have to immediately intervene with lower rates. You remember the fighter Mike Tyson. Mike Tyson said, everybody has a plan until they get punched in the face. Well, I think that's the Fed today. They have a plan for systematic rate hikes, a plan for a gradual cooling off of the economy, a plan for small increases in unemployment and gradually lower CPI back to 2%, and then everything goes back to normal. The plan looks great in their simulations, but the chances of things happening according to plan are small in my view. So I think it's unlikely we have a smooth rate hike, an orderly decline in the stock market, a gradual decline in unemployment, and a symmetrical decline in CPI. The Fed's going to feel compelled to fight inflation the old-fashioned way by killing demand, but something will get wrecked. Some firm, some industry, some foreign central bank along the way, and inducing some kind of a panic sell-off of financial assets that spreads to a large part of the economy and maybe the entire financial system. Or if the Fed doesn't wreck it itself, we could have an exogenous event like a war that our financial system is just not equipped to handle. So what I suspect will happen is that seemingly out of the blue, we won't see it coming. The financial bodies are going to start floating to the surface, and the Fed will react by printing money, most likely to the central bank or to the industry or the systemically important company that needs to be saved, whatever that is. And when they do this, they're going to say it's an emergency action and not part of their monetary policy. That's what the Bank of England said when they intervened to save the British pension system a few weeks ago. But that will not be true, because their expansive monetary policy is what causes the asset bubbles to get too big and the debt to get too high in the first place. So whether they like it or not, all the boom and bust that characterizes modern central banking is part of their policy. It's inherent in their actions. Now, I'm speculating a bit, but in the end, my guess is that some emergency is going to intervene so they cannot complete their inflation fighting program. They'll have to inflate again in the middle of their program by lending new money to some troubled entity or industry. And they'll, in the process, they'll have to accept a higher rate of CPI inflation as their new normal. I expect they're not going to be able to hold CPI inflation at their magic 2%, but they'll instead have to accept higher CPI inflation and higher interest rates for some years to come. And that probably means slow or negative growth in many countries. So yes, I think, and I'm speculating here, but I'm saying probably here comes stagflation. Okay, so to summarize, the Fed will eventually pivot, but they won't pivot because they're happy with their CPI numbers or because they're afraid that stocks are going down too much. The Fed wants and needs stocks to go down because, as I pointed out, a negative wealth effect is key to their strategy. The Fed's going to execute the plan laid out in Jackson Hole in August until they can no longer execute the plan. Now, just to review, Powell was unequivocal in that short speech, and he stressed the following points. The FOMC's overarching goal is to bring inflation back down to their 2% goal. That will require prolonged restrictive policy. History teaches us not to ease monetary conditions too early. We understand this policy will cause unemployment and pain to businesses and households, and we will, quote, keep at it, unquote, until the job is done. And there he's channeling Paul Volcker and his book, Keeping at It. Okay. So I think that the Fed will continue to push interest rates up and slow down money creation. This is going to continue to cause stock prices to fall. It'll increase the negative wealth effect. Higher interest rates will lower business investment. Lower levels of investment will reduce the demand for labor and increase unemployment. Lower uninvestment and higher unemployment are going to slow down economic activity in general. You get less consumer demand, less money spent, and slower price increases. That's the Fed's plan. And all of this has to show up in their core CPI number because that is the metric the Fed uses to gauge its success. That's their guiding star. That's the number they have bet their careers on. It doesn't matter if they slow the economy and don't get the core CPI number they want. They're going to keep banging on it until they get their number. Because if they don't reach their 2% core number and core CPI goal, they are failures by their own standards. They're self-proclaimed losers, and that is not an option for them. So they're going to keep pushing interest rates until some big surprising event intervenes, as it almost always does. Then they're going to resume QE, but they'll call it something else and say their resumption of QE is not really monetary policy, but a necessary response to a, quote, financial emergency. So the bottom line is, and here is why I titled this discussion, Be Careful What You Wish For. The bottom line is this. The Fed is boxed in by its own policies because it has to stay committed to its policy until something bad happens. So if you're wishing for a pivot, a step down in the rate of interest rate increases, be careful what you wish for, because I believe that when the pivot or change in policy comes, and it will come, it could be in response to a serious crisis that nobody wanted to happen. And at that point, the pivot's probably not going to be enough to save the stock market from further declines. Okay. All right, let's stop here and see if there are questions or comments. And then in the remaining time, I'll have some comments. I want to make some comments on gold. So what do we have?
So we have some super chats. We have a super chat from Mary Aline. Thank you so much. Another one from Jeff Bannister. Thank you so much. Another one from Mary Aline. She says the Wall Street Journal seems to want to canonize Janet Yellen.
Boy, that's a really good observation, Mary Elaine. And she probably should go to the other place, not to heaven. Janet Yellen, just weeks ago, I'll go back. 2 years ago, Janet Yellen said she does not foresee another financial crisis in her lifetime. Really? I mean, she thinks she's got so much. That's when she was the Fed chair. She thinks she's got such a great handle on that. Just recently, she said, I do not see any disruptions or problems in the treasury market that mirror that are anything like the UK problems, the UK gilt market. And then just on October 14th, not long after that, she has to say, whoa, we got some liquidity problems in the treasury market. I mentioned this today. I think maybe we're going to start, buying back some of the off-the-run treasuries. I mean, is this lady clueless? I don't know. Okay, so I'll stop. She has a PhD and I don't, but far from being canonized, I would send her the other way. All right, well, thank you all for your comments, by the way.
We have
go ahead.
another super chat from Enric. Thank you so much. He says, could it be good to sell on such false rallies?
Okay, on the premise that this is a bear market, that's exactly what you do. So if I'm right that this is a bear market, and you can see the sawtooth pattern that I won't go back to it. You remember the sawtooth pattern, the channeled sawtooth pattern as the market goes down. That's what bear markets typically look like. You never know when they're going to reverse, and 20% is a lot. My sense is we're not done yet. And I could do a whole thing on why stocks are still very, very highly valued, even after they're down 20%. They're highly priced. So, yeah, I would say that wouldn't be a bad strategy. But, again, I'm not a market timer, so I won't go too far with that.
We have a super chat from Dwayne. Thank you so much. And a comment from Robert. He's asking, so time to get out of equities?
I should have known you guys were going to ask me. I'm not going to answer that directly because I don't give investment advice on this forum. I can tell you I am not out of equities. I am out of certain kinds of equities. And if you want some comments on that, I'll give you a link at the end of the program, and you can watch an interview I did for Monetary Metals and Company a couple of weeks ago. Okay. But thank you for the question. All right. So, and I'm now going to skirt close to a financial recommendation. And you all know that I'm in favor of everyone owning gold. Let's see what I'm time here. I got about 18 minutes. Okay. In some amount. Years ago, when I first started out as a stockbroker working for Merrill Lynch, the company recommended that all investors should put 5 to 10% of their investment assets into gold. That was in 1984 when CPI inflation was receding, but it was still strong in the memories of everyone. And I think that is good advice today. And perhaps it's even too conservative, but I won't pound that drum too hard because your mileage may vary. You need to decide for yourself if you want to put some of your savings into gold or gold-related investments. As I said at the beginning of this talk, the markets are pricing in a lot of faith that the Fed is going to get inflation under control with some kind of a big blow up. So I wanted to go through what I think is that if right now we don't have high expectations, as I tried to show here, we don't have high expectations of inflation. But when and if the expectations of embedded inflation takes over, that should be when you see gold go up in dollar terms. Gold is going to do well once people realize that inflation is not coming back down to its pre-2020 levels, but that maybe those CPI inflation numbers are going to settle higher, like maybe in the 4 to 6% range. Okay, so I want to show you a few things. the disappointing performance of gold this year is somewhat clouded by the strong dollar. In yen, for example, gold is, right at its all-time high. So if you were looking to hedge against the decline in the value of the yen, you would have done well owning gold. Since 2019, gold's gone up over 70% against the yen, and that's roughly twice as well as it's done against the dollar. I'm sorry, that's twice as well as the dollar has done against the yen. So if you think of gold as a currency and an alternative to other currencies, you can think of it as a hedge against other currencies. Now, I ran across a pretty good article on gold on the Mises Institute website called Gold as Natural Money by the veteran gold analyst named James Turk, T-U-R-K. And I recommend you read the article. And I wanted to highlight a few of Turk's points here, but I think I'm not going to have time to do it. So I'm just going to mention this. It's called, go to Mises.org, MISES.org. The article is Gold as Natural Money. And just a couple of few highlights. Gold does not need a central bank. Gold money's only proper relationship to the government is that the government should enforce contracts written and settled in gold. So unlike fiat currency, gold needs no other government involvement. Gold is money but does need the support of law and the support of individual rights. Gold is money that really manages itself because growth in the gold stock, the money supply, is controlled by two natural facts: profitable mining of gold and the physical attributes of gold, the fact that it is virtually indestructible and rare. Together, those forces impose discipline on the production of gold that prevents the quantity of gold money from getting too high relative to economic production. Now, that's a key factor in explaining why gold preserves purchasing power over time. So what I'm saying is that gold production, mining, because it competes for the same resources as industrial production, in a market economy, its value relative to other commodities and industrial products over time stays in check. All right, so I want to illustrate this with a very interesting chart. I wish I had better detail on this. This is in Turk's article. Just stay with me a minute here. This chart here from Turk's essay illustrates the consistent value of gold over time. The analysis records the price of crude oil since 1950, priced in gold, and well as being priced in the dollar and in the pound and the euro. I would note the euro did not actually exist before the 1990s, but its value was initially defined by the German mark. So that was the preceding currency for the euro that's used as a proxy here. Okay. But you can see that compared to these major currencies of the world, gold still buys. See the gold, look, gold is way down that yellow line on the bottom. Gold still buys as much oil as ever, or stated another way, the price of oil has hardly changed in terms of oil. And I want to emphasize two things about this graph. First, it illustrates the long-term consistent value of gold over time. And second, it prices what is perhaps the world's most valuable industrial commodity, crude oil, in a very stable currency. As you can see, both commodities, both oil and gold, seem to be pretty stable in relation to each other. Now, some people are disappointed that gold hasn't risen more in price recently. After all, we're getting big CPI inflation, and gold is actually down versus the dollar since CPI inflation became a big problem this year. But I would not let that weakness discourage you from investigating gold as a way to save. My view is that gold is likely to remain modestly priced in dollar terms as long as the Fed continues to tighten monetary policy aggressively, but it should do better relative to the dollar when the Fed finally does have to pause or pivot or step down or whatever the popular terminology is at the time. Gold is a currency, but it also competes against other investments. Environments with strong corporate earnings, with or without Fed tightening, are usually good for stocks, but not usually good for gold. That was the stock market in 2021. Earnings were strong. Stock prices reflected those high earnings, and gold was, pretty flat for that year, end to end. Today, in late 2022, and most likely into 2023, the economy is decelerating, which is good for gold. The Fed is tightening monetary policy, not really very good for gold, but still corporate earnings are declining, not good for stocks, so maybe that helps gold a little bit. But if the US economy develops severe recessionary conditions and the Fed then eases monetary conditions, that's when earnings will still be bad. But people at that point, I believe, would begin to prefer gold. So eventually, I think we're going to see financial repression in the form of high inflation and low interest rates, meaning low or negative real interest rates. And that would likely be the best environment for gold to appreciate versus the dollar. And I'll have to talk about that more at some other time. Okay, now these next two charts, this chart and the next one, this one shows the gold price in dollars and the gold price in euro. And you can see that in euro, it's off a little bit from its high, but still, not bad, off about 6% versus the euro. So if your currency is euros, you wouldn't have done too badly by putting your savings in gold. Not great, but better than the dollar gold relationship. Now, this is again from Lynn Alden. You can see the top, the gold ETF, exchange traded fund, which just mirrors the price of gold compared to other active investments. It's down about, it's the number on the top, the GLD is its symbol. It's down like 10% this year, as opposed to all the others, including, look at the middle one, the S&P 500 down, it's not down 23 today, it's up a little from that, maybe down 20. And the 7 to 10 year treasury bond down almost 16%, which is supposed to be super safe. So, consider that gold hasn't outperformed, but it hasn't outperformed. It hasn't positively performed in dollars, but it's outperformed most other things. All right. So just a final shout out before I say goodbye for today. I've mentioned Lynn Alden before, and I want to do it again. In addition to her comprehensive view on the economy and investing, she has a good perspective on gold investing. And like me, she likes gold royalty companies for the long term. These are companies that have no risk of operational costs, such as high fuel costs that can eat into a miner's profit. These company revenues basically consist of a right to be paid based on a percentage of the sales of the gold miner. So you get all the exposure to the upside in the gold price with no risk related to the profitability of the mine. So again, I'm not going to be offering specific advice here on individual names, but I recommend that you, one, investigate gold ownership to decide if it's right for you, and two, subscribe to Lynn Alden's newsletter, just lynnalden.com. You can get it free. You can try before you buy. You can get a free subscription for starters. Her regular newsletter is very reasonably priced, and there's lots of bang for the buck. And by the way, I don't know Lynn Alden personally, and she has no idea I'm recommending her. So don't think we have any financial relationship. All right. There's your cartoon for the day. Hope you all have a happy Halloween. And just as a real quick reminder, you can find me on Substack. I'm Hard Money Jim. I'm not much on Twitter, but I'm at Hard Money Jim. And I just did I told you I'd recommend this. I did a interview with Keith Weiner from Monetary Metals and Company. Full disclosure, I am on the board of Monetary Metals and Company. And we did a interview at the New Orleans Investment Conference a couple of weeks ago called Financial Repression and Zombification. It was a fun discussion, and we covered a wide range of things. You might find a nugget in there that's worth keeping. No pun intended. All right. We're about out of time, so anything to wrap up, Daniel?
We have a super chat from Kathleen. Thank you so much. She says, great to have you back again, Jim.
It's good to be back, but I have to tell you, doing this every week is really difficult. I wish I had a faster brain, but I really have a hard time putting together anything I consider a quality presentation every single week. So that's why I opened it up. I'll do it as often as I can, but that's why I opened up calling it Finance Friday, our almost sometimes weekly podcast discussion. Maybe we can find some good content to fill in when I just can't put something together. We'll work on that. All right. Thank you very much for watching and listening, and I hope to see you next weekend. Take care, everybody.